Rob, thank you for that kind introduction. Thank you for inviting me here today. I want to share a story before I turn to the notes, but I remember just about 2 years ago now, maybe it was in January of 2009, and I came into these offices and I met with your colleague Tyson Slocum, and it was at a time where the then President-elect had suggested to the nation that he was going to nominate me when he became president to the post of the CFTC chair. And I was doing some meetings and came over here to see Tyson and walk through actually the President-elect's agenda, though it wasn't known to people, and on bringing over-the-counter derivatives to regulation. And it was a very constructive meeting. I learned a lot, and here I am, I guess 2 years later, back in the same building. So I thank you for inviting me. I thank Tyson for taking the meeting 2 years ago.
Of course. He took some flack for it, believe me.
He did, yeah. Well, understood. But the 2008 financial crisis really left us with many lessons, and the financial regulatory system and the financial system failed the test for the American public. Now, at the CFTC, we swim in the lane of derivatives, as Rob mentioned. And last July, of course, Congress passed a broad reform bill, but one of the things it does in Title VII is brings regulation to the over-the-counter derivatives markets, or what we'll call the swaps markets. And these swaps did play a role in the financial crisis. There were a lot of other things that happened, no doubt, but part of the story, part of the lessons learned was related to derivatives. And markets work best when they are transparent, when they are open, when they are competitive, and the American public benefits from those attributes. They currently benefit in something called the futures marketplace. That marketplace has been around for about 150 years. It took about 60 years to regulate that market. The swaps marketplace started in the 1980s, and so it's about 30 years to bring similar reforms to that market. And Congress directed the CFTC and the SEC to bring similar features that were in the futures market, features that are in the swaps market, features that are in the securities market, to what's called the securities-based swaps markets. Now, the CFTC is charged with overseeing currently the commodity futures markets. These markets are agricultural commodities such as wheat and corn and cotton, includes energy and metals markets such as crude oil, natural gas, gasoline, and of course gold and silver and copper. And lastly, it also includes financial commodity futures on interest rates, on stock index futures. We saw that on the events of May 6th, as you can recall. And of course, on foreign currency. So the markets that we oversee, the regulatory oversight, affects tens of thousands of farmers, ranchers, oil producers, corporations, anybody really hedging a risk in the financial markets and the agricultural markets, energy, metals, and so forth. To fulfill our statutory responsibilities and to continue to oversee the markets, the CFTC needs adequate funding. And I thank Rob for mentioning that. Now, I believe, is the time to invest in oversight of the derivatives markets for these key commodities. That's the agricultural and metals and energies and financial products. And it's for the futures markets as well as the new authorities in the swaps markets. The CFTC is a good investment for the American public. The agency actually peaked in terms of staffing in 1992 at about 630 people. And through the past decade, it shrank nearly 25% and troughed in 2007 and 2008, down around 440 people. And with the help of Congress and 2 presidents, we were able to get back just this past year to about the levels we were at in the late 1990s. We're about 675 people currently. But at this point in the history, the commodities and futures markets have grown substantially. The markets that we oversee are about $40 trillion in notional amount, well over 5 times what they were just 10 years ago. And we've been tasked, along with the SEC, to oversee a market that's about $300 trillion of notional size, or about 7 times the size of what we currently oversee. Is it a good investment? I think so. This past year and this year, we're at $169 million in funding. That's because we're in this continuing resolution currently through this Friday, March 4th. The CFTC's resources are used primarily for staff and technology. We don't have any grant programs or the like. As I said, we have about 670 people, thoughtful, experienced, resourceful, and dedicated to the agency's mission. But staff's not enough. We also spend about 18% of our budget on technology. The futures market has evolved primarily. It's electronic. It's increasingly algorithmic trading. And there are 12 million contracts that trade a day in the futures market. So the CFTC certainly needs to invest in technology. This past year, about 18% of our budget, $31 million in technology. It's only through investment in technology, though, that we can capably oversee commodities and futures and the new swaps marketplace. Faced, as we are currently with a continuing resolution, we have had to make difficult choices. Of course, we've cut back on travel and other things that we can cut back on, but unfortunately, we've also had to cut back on technology. And effective oversight of the markets, though, requires us to invest in both staff and technology. The President's fiscal 2011 budget actually requested significant increases in technology and increases in staff, a greater percentage increase in technology than staff. For 2012, not the year we're in, but next year, the President's request of $308 million includes doubling the technology budget and about 45% increase in staff to help us police the markets. Now, if the CFTC funding were actually taken back to 2008 levels, we were only at $112 million. About a third, as Rob said, less than our current funding. And we only had about 440 people at that point in time. The agency would be unable to fulfill its statutory mission. Every program would be affected. This would be including surveillance, industry oversight, enforcement. We'd be unable to pursue fraud, whether it be Ponzi schemes or market manipulation. And we'd inevitably develop a backlog of registration applications when people come in and want new registrations and the like. It would leave a lot of uncertainty in the marketplace. So I'm hopeful in working with Congress that we're able to secure funding not only in 2011, that is at least where we are, or as the President requested in 2011, greater, but also to secure resources into 2012 as we move forward. Let me turn now to the Dodd-Frank Act, talk a little bit about transparency and competition and how not only that works in markets, but also what the bill did inherently in that. We know that sunshine is important to markets, transparency in marketplaces, and that the swaps marketplace to date has been rather opaque. Economists and policymakers know and have studied for years that transparency benefits the public. The more transparent a market is, the more liquid it is, the more competitive it is, the more that end users can get the benefit of that in their hedging. There's two types of transparency. One is to the regulators and one is to the public. The Dodd-Frank bill said to the regulators that we would be able, for the first time, to really see all of these transactions. The SEC, the CFTC, the banking regulators would have that information in data repositories. But the second type of transparency is to the public. And this public transparency Congress addressed in 3 critical ways. One was before the transaction occurs. That is sometimes called pre-trade transparency. It happens on exchanges, in the futures markets, and in the securities markets, and in the swaps marketplace, in this new category called swap execution facilities. And it allows hedgers and investors to actually see some pricing before they enter into a transaction. The Dodd-Frank Act requires that standardized swaps, those being cleared and made available for trading, would have to be traded on venues. Now, Congress did have exceptions. They have exceptions for something called block trades, the large transaction, $1 billion transaction, for instance. There are also exceptions for the commercial end users, where Congress has explicitly said there's an exception for clearing, and thus there's also an exception for this transparency. But where there's going to be standard transactions, small enough that they're not blocks, between financial entities, there should be pre-trade transparency and people benefit from it. The second part of transparency is after the transaction is entered into, what often people call post-trade transparency or real-time transparency. And Congress was very specific. They said this post-trade transparency, other than the blocks again, must be achieved as soon as technologically practicable. So we published a rule late last year, and we're looking forward to public comment on it with regard to that. And Congress said there should be a delay for those blocks, the larger transactions, and we included that in the rule as well. The third phase, these transactions and contracts last years, sometimes 30 and 40 years. So that phase is also important. After the deal is done, what's the transparency later? And Congress addressed this in two ways. They said that every day for those 30 or 40 years, the transaction has to be valued, or what's called mark to market. If it's cleared at a clearinghouse, the clearinghouse has to publicly say what the value is every day. If it's not cleared at a clearinghouse, it's what's called a bilateral transaction. Then the swap dealer has to at least share with the market participant the valuation. And anyone who's read about the AIG debacle knows that there were a lot of disputes about the valuation. So one great way to lower risk, Congress addressed and says you have to share these valuations. Now, transparency alone is not enough to promote competition. Congress also addressed promoting open and competitive markets through a series of open access or impartial access provisions. I'm just going to note three very quickly. One relates to the swap execution facilities and exchanges. Congress explicitly said through its core principles they have to have impartial access. That means as long as somebody wants to enter the marketplace, they can actually have access into the swap execution facility. And we published rules again late last year, and we're looking for public comment, where we provide that market participants would have the ability to leave firm bids and offers in the marketplace, and other market participants would be able to see those firms' bids and offers. Secondly, we said that if a market participant meets minimum financial requirements and meets minimum fitness standards, they would have access to that central marketplace. So there would not be sort of you're out or you're in. As long as you meet fitness standards and certain financial requirements, you can participate in the marketplace. This access brings competition to the marketplace, and it's critical. The other place that Congress addressed was clearinghouses. They explicitly said there'd be open access to clearinghouses and something called non-discriminatory access to clearinghouses. Two very important features. Open access to clearinghouses really builds on how the securities markets and the futures markets are arranged, where there are parties called futures commission merchants that have access to the clearinghouses. We published rules in the fall that build upon that. And the proposal specifically says that futures commission merchants can become a member of a clearinghouse, and the clearinghouse certainly could require that they have to meet operational standards and various financial standards, but they can't exclude them simply because of the amount of the capital they have. They can scale them. Non-discriminatory access, which is a feature Congress addressed as well, says that regardless of where you might trade a swap, you can have access to the clearinghouse. So it won't be integrated. It won't be that one trading venue is picked over another trading venue. One other area I wanted to address before taking questions is position limits. And I know that that's something that this agency, or this organization, has addressed itself to. But since the 1936 provisions that established our predecessor, called the Commodity and Exchange Authority. We were once part of the Department of Agriculture. But since that point in time, our agency has had provisions and authorities to set position limits. And this was to protect the public against the burdens that might come from excessive speculation, including those that might be caused by large concentrated positions. And though the CFTC does not set or regulate prices, Congress recognized that it is part of our role to promote the integrity of markets that they gave the CFTC or its predecessor this authority. And in fact, working with exchanges have set agricultural limits, limits in the energy markets, limit in the metals markets from time to time. We currently do set position limits working with exchanges in the spot month on all of those markets, energies, metals, and agricultural. In what's called the out months, the all months combined, we do it in the agricultural markets. So the CFTC in the Dodd-Frank Act was directed to extend this authority to part of the swaps markets, where they play a role with the futures market, either that they're economically linked or very similar to the futures markets. So the CFTC has published proposals in this. We published in January. We look forward to the public comment period. But at the core of our obligation is promoting market integrity, which the agency has historically interpreted to include ensuring that markets do not become too concentrated. And position limits help to protect markets both in clear skies and in stormy skies. So just in conclusion, I want to say we can't lose sight that the fact that we had a financial crisis in 2008. Congress responded and determined that significant changes must be made to the market regulation to bring transparency, lower risk, and help prevent the next crisis. We're working now to implement those reforms. We've published a significant number of our proposed rules. We have a bit of a pause right now. We're looking for comments, and it's very important to get comments from the public. We benefit significantly from the public comment process, and I encourage everybody here, not only a public citizen, but anyone in the public, to help us. The final rules will change based upon public comment. That is the nature of our rule writing process. So I thank you, and with that, Rob, glad to take questions.
Thank you very much. Well, let me say first that we're glad that even with the budget cutbacks, you were able to manage the travel over here to DuPont Circle.
I'm glad.
And
four blocks was allowed.
Just to the edge of it. I have one question. I know there's a lot of questions here. Maybe stepping back from some of the specific things you're talking about and a little bit more philosophical. It's always striking to hear the notional amounts of the trade and even the non-notional amounts and all these derivatives as against the size of the real economy. And it's hard to avoid the question of that. Is the thing just basically completely out of control? Whatever is sort of the public rationale is for these kind of trades and derivatives, are we just at a scale to that and now have a market that exists for its own sake with obvious dangers that we've now witnessed, divorced from the underlying benefits and public purpose? And so that's sort of a general piece, but the specific applications are, does that mean that we ought to be thinking about trying to shrink the size of the market or prohibit certain kinds of contracts that don't seem to serve any direct public interest, or at least as against their benefit? And should new ideas like derivative contracts on pending movies have to get approval from you before going forward and being permitted to exist as derivatives? Well,
derivatives came into being in our country around the time of the Civil War. At the time, it was for farmers to hedge the risk of their crop. Now, fast forward 150 years, they're used for many other features, and financial derivatives and energy derivatives that came along around 40 years ago. So they're really important, and most corporations, many cities and municipalities use them to hedge a particular risk. It could be a price risk if you're importing something from overseas and it's a currency. It could be an interest rate risk on mortgages or a credit card, and certainly in the agricultural markets and the energy markets. So they're critical. You're correct at the size of $300 trillion that arithmetically is about $20 of swaps for every dollar that flows through the economy. So you can think, if you fill up with a tank of gas, it might multiply. I know that tank of gas costs more today, but if you can multiply by 20, somewhere in the economy, arithmetically, there's those derivatives. What Congress did was fill the gap. What Congress said is this market needs oversight through transparent markets, through clearinghouses. The dealers need to be regulated to lower risk, that the public never bail out one of these entities again. It gives the SEC and CFTC the authority to police. You need a strong cop on the beat. We need the funding. We need the technology so there can be a cop on the beat. But I think the contracts themselves do have a real benefit ultimately so that end users and corporations can hedge risks. I don't know if that answers your question.
It's an answer of a kind.
Well, so my answer of a kind is these are contracts that are used by many to hedge a risk, but without a transparency, without a centralized market, without dealers being regulated, and without the SEC and CFTC having funding, there's risk to the public. And so that's why I certainly supported what Congress did. It was historic. That's why I'm advocating for funding.
Okay, I have more, but we'll open it up first.
Just as a follow-up on that, and thank you for your leadership, Chairman. It seems like there's a vast power imbalance. If it's true still that the 5 big banks dominate, have 95% of the contracts, and now with the Citizens United decision that Public Citizen is leading discussion and advocacy around, the influence of corporations and their trade associations in our legislative environment exceeds our wildest nightmares. It seems like those banks and their executives, in spite of their statements, really see that their self-interest is in no regulation or the status quo or less regulation. So if they have such outsized influence, and they won't suffer the consequences of you not being able to buy new technology or having to lay off staff, we will, taxpayers. Where does it all end?
Well, a number of questions there. One of the things that we've actually done as an agency is open up our rule making even more than we already had. So we list every meeting with an outside organization, whether it's with Public Citizen or a large bank, whether it's an industry association, sometimes whether it's a phone call or a meeting. And you can go to our website and see the 500 to 600 meetings that are there. And it is part of the rulemaking process that we benefit from all of those comments. Now, sometimes they conflict, and they have different points of view, and that's why we have 5 commissioners, and they're all very engaged and very thoughtful in trying to sort through this. I think where we are is that we have this natural pause right now. We're going to get thousands of public comments, and in the spring and summer, we're going to move towards writing final rules, and we'll benefit from comments here. We do not have the staffing or resources, technology or otherwise, to actually take on the new mission yet. So we'll work through the rule writing. We'll work with something called a self-regulatory organization called the NFA to see what they can take on as well. But I would, if I might, Lisa, say that I think that all market participants, the tens of thousands of people that use these products, benefit because this is a good investment. It's only $169 million this year. The president has asked for 2012 for $308 million, but that's very small compared to the dollars that went into the crisis in 2008. And it's very small compared to the over 7 million jobs that were lost, and the knock on our economy that's going to take years to work through. So I think it's a very good investment.
Let me just say, I wasn't implying that you or your fellow commissioners were being corrupted by the influence of money in politics. I was referring to the Congress and the continuing resolution. And I agree with you that it is a good investment, but I see that there's a case of haves and have-nots, and the haves see it as in their best interest to not have regulation.
We've actually have had, I think, support and comment from a wide variety, and with about, I think we have 42 proposed rules out for comment right now. Large organizations, small organizations have all been very, I'm very grateful for everyone's comment.
Follow-up to that, if transparency is good for the end user, then is Coca-Cola or American Airlines, what's in a fully budgeted, fully financed CFTC for them?
I think that a market oversight ensures for all the end users, the two you named and others, that the market's transparent, that when they go into the marketplace, they benefit from knowing what the last transaction of, for instance, a 2-year interest rate swap was. That market is free of fraud and manipulation, and that the risks that built up in the system, the risks that were part of the financial crisis, they're not as prone to. Because those two companies and thousands of other companies did not make their 2009 budget. They were prone. They had to, unfortunately, lay off staff and react to a diminished economy. So one, they benefit from transparency in their own hedging. Two, they benefit knowing there's a cop on the beat to make sure that markets are free of fraud, manipulation, and other abuses. And three, I think they benefit lowering the risk of the calamity that we had in 2008.
Well, is there any application pending? I mean, if I'm Coca-Cola and I'm trying to hedge my corn purchases, is the fact that you're 100 FTE short going to affect me?
The good news for them is they don't have to apply with us. They don't have to apply with any regulator. They're able, and Congress addressed that they can use these products without coming into the clearinghouses and the like. But where their benefit for funding an agency like the CFTC is that markets work best when there is an effective cop on the beat and when there is the transparency. I hope that answers the question.
Well, you've obviously faced a lot of opposition from the end users. They apparently don't agree with what you just said. What's the explanation for that, at least for some organized end users?
We've had very constructive dialogue with the non-financial end users, and what they have said and what Congress did was to say that the clearinghouses lower risk and where transactions have been brought into for over a century in the futures market, that they would have a choice, an option whether to use those clearinghouses. Consistent with that congressional intent, that's the approach that we'll take at the CFTC to applying margin, that the commercial end users would again have a choice in their relationship between themselves and dealers as to whether they have any margin arrangements. But we wouldn't. We would do consistent with Congress. Those have been the two big discussions. Are they in clearing? No. Congress said no. Are they in margin? We haven't published a rule yet, but consistent with what Congress has said. With regard to transparency, they are the great benefactor of transparency. As long as that transparency doesn't address some of the big block trades, if somebody was doing a large block trade, and Congress appropriately addressed that and said that the block trades don't have to come into the first part of the transparency, I said pre-trade transparency.
If you take outside the Beltway perspective, and hearing that no one knows what your organization does outside the Beltway, and congressmen are getting intense pressure to cut the budget and have a balanced budget, what do you say to someone outside the Beltway who says, I don't know what you do. And if I look at my investments, I may have been moving some of it to commodities in the fall, maybe not now, but in the fall. If I had to choose priorities of budget, I'm not sure I would spend the money on your organization, although inside the Beltway I would say sure. Outside the Beltway, you know, it's a list of alphabet soup agencies. What would you say to the outside the Beltway average investor?
Similar to what I would say to somebody inside the Beltway. I think that this is a very good investment. We as a nation have an enormous challenge with the budget situation we're in. Part of it is because of the 2008 crisis. I think the financial regulatory system did fail the American public, and in part, but we need to invest in agencies like the CFTC and like the SEC to ensure that we can actually put in place what Congress asked to be put in place in the swaps marketplace. If the discussion went a little further, I might talk about credit default swaps as well, but it depends how long the conversation would go.
You know, an average person, I'm not sure would even know the terms that you're referring to, and so they would look at your agency or a lot of other agencies and say, you know, my focus is balancing the budget. And I think while inside the Beltway and those in the know would probably argue to increase your budget, I just think outside the Beltway you would have a tough time, and that's all I've been saying basically.
Mr. Chairman Gensler, 2 weeks ago the CFTC and SEC released a joint report recommending a number of changes to market structures in response to the May 6th flash crash. I'm interested in hearing your reactions to the report and what, if any, actions you envision the CFTC taking in response to the report's recommendations. We're
very appreciative of the advisory committee's report. They had 14 recommendations. Some had sub-recommendations. And so we're still sorting through that. But I think it's going to be very helpful to our agency as we continue on the rule writing. More specifically, we've asked staff to make some recommendations on supervision and testing, particularly in the new world of algorithmic trading. I think it will help us with regard to, as we move forward, to try to finalize rules for exchanges and these new swap execution facilities. And I look forward also to working with the SEC around their recommendations on cross-market circuit breakers. But I think there was a lot there, and we're appreciative for that committee's work.
Good to see you.
Good to see you again.
You use the phrase financial end user, and you don't often hear firms stating, I'm really not an end user. To what extent is that phrase oxymoron? Maybe you can shed some light on how you're thinking about the distinction between user, non-user, non-user, and finally, what is provided for in terms of
what's it provided for?
What are you thinking about in terms of mixed trades, where you have, in terms of margin requirements, transparency requirements, where trade involves an end user and a non-end user?
Okay. So Congress, in pulling together this reform bill, recognized that there are various users of these derivatives. One group of users are the dealers themselves, the large, usually banks, but AIG wasn't a bank, so sometimes non-banks. A second group were financial companies. Think insurance companies and hedge funds and leasing companies. And then a third category were end users, which were not financial companies. In the statute, it's called non-financial end users or commercial end users. Looking at worldwide statistics, about 9 or 10% of the market is with these non-financial end users, and 90 or 91% of the market is between dealers and financial companies and the like. So Congress wanted transparency for 100% of the market, but only between the financial companies would come into the clearing houses and come into the swap execution facilities. So we're really just following the congressional mandate. We're going to follow that. as well that intent with regard to margins. So for the second part of your question, if a non-financial end user enters into a transaction with a swap dealer, they're exempt from clearing as long as they're hedging a commercial risk. And though we have yet to put forward the margin rules, we're going to be at the CFTC consistent with that congressional intent. Tyson.
Hi, Mr. Chairman.
Good to see you.
Good to see you as well. Thank you very much for coming to Public Citizen and all your leadership on a number of really important issues. So oil is hovering around $100 a barrel.
Figured Tyson would ask the oil question.
Yes. A debate I had on CNBC this morning actually wasn't much of a debate. The talking heads on CNBC were in agreement that speculation appears to be driving another oil price bubble, that the price of oil has become disconnected from the supply-demand fundamentals. There's a number of analysts who fear that sustained high oil prices could threaten an already fragile economic recovery. And prior to the current run-up, data released publicly by the CFTC appears to indicate that there's an increase in some of the net long positions by non-commercial investors. So the question is, what role could enacting position limits or other regulatory actions curtail the role that speculation is currently playing in energy markets?
Two thoughts. One, with regard to the overall swaps regulation, there's really right now a gap in the transparency to the public and to the agency in what's called the swaps marketplace. And back to what somebody outside the Beltway, we currently regulate something called the futures marketplace, and that's about 1/7 of the size of this other market we don't. Just having that transparency, having that aggregate data, the public will benefit to seeing that information. You referred to some information we put on our website. It's only the futures marketplace. We don't have that other information. So I think that transparency will be very beneficial to the broad public. It will take some time. It's not going to happen overnight. With regard to the other part of your question, this authority that we've had since the 1930s with regard to position limits, though we're not a price-setting agency, that is not the mission we have. The mission that we do have is to ensure for the integrity of markets. And part of the way we've interpreted it over the decades is to ensure that no party gets so concentrated in the market, or that the markets themselves get so concentrated that they benefit more from the diversity in the marketplace. So we've put out a proposal in January, and we look forward to comment. We put out a proposal in the energy markets in January of 2010 to reinstate position limits in the energy markets. We got over 8,000 public comments on it, and we benefited greatly from those comments. We had to re-propose those limits because Congress had acted in the meantime. There were new laws and new authorities. But I suspect we'll get a great many of comments, and we'll benefit from those.
May I ask a quick follow-up? Regarding data analysis and processing information so that the CFTC can be better informed on some of these issues, had the agency obtained any voluntary agreements with some of the major players in the swaps market? And is that data relevant to being able to make an informed decision on enacting position limits? I think the information we get from swap dealers through what's called special cause. We have an authority to call upon certain market participants who are otherwise large traders and get some additional information. We've been doing that with swap dealers for about 2.5 years. And that's helped us put information out about index investors. But it is not specific. So it's helpful, it's relevant, but it's not specific contract by contract. It doesn't give the details that we will get. It will take us now a period of time, but with the new law that Congress passed, we will get a great deal more information than that which we can get today. Thank you.
And then in the back.
Who benefits from cutting the CFTC budget?
Well, we have a great national deficit, so
There's obviously that side, but then there's the other, the budget side. But who, like, I think the national.
Well, I don't think I'm going to take the bait. I think we're a good investment. I think the CFTC has been very efficient. We've only in the past year gotten back to the size we were in the 1990s. We're a little bit larger. I think we have 676 people right now. We're a very good investment. We need to put more resources to work because of the size and breadth of the markets that we've been asked to regulate. We need to do it in both technology and people. It can't be one or the other. And in fact, the President's 2012 budget was a doubling of technology when it's about a 45% increase in staff. We want to leverage the technology to do this efficiently. So I think the American public benefits, and it's a good investment.
Am I allowed to ask a question?
Sure, Kathleen.
End user exemption. How big a loophole there's lots of companies that are end users and speculators, and major in both. How much of the speculative side of their business could they pull through the end user loophole?
Well,
or exemption, I don't need to call it.
Congress mandated that if you're a financial company entering into a transaction with another financial or a dealer, it's brought to the clearinghouse. But if you're not a financial company and you're hedging a commercial risk, you don't need to come to the clearinghouse. So we published a rule in, I think it was in December, where got a lot of public comment on it about this very question that you raised. But what we proposed is if somebody's hedging an input, hedging merchandise that they're either buying or selling, hedging a commercial risk, that they would be a commercial end user. I don't know.
For all purposes of their
No, for those transactions. For those transactions. Most commercial end users, in fact, I would say the vast majority, use derivatives to hedge a risk.
Right. But there's some who also sell that expertise that they've gained in the speculator market, and the pure just people not hedging. Would they be able to be exempt on those trades?
If somebody, I think Congress was clear, if somebody is not a financial company, but they're speculating, and assume that from your question, they would agree with you they're speculating, then they would have to use the clearinghouse. Your concern is there a gray area?
Well,
and that's why we have that's where we have a rollout, and we're looking for public comment as to. Dan?
Just a very quick follow-up back on the budget. I understand that the President's request included something on the order of $120 million in user fees. You have the authority to raise it. I think it's slightly in excess of a third of the $308 million that way, but that requires congressional action.
Mm-hmm.
Just wonder what you think the prospects of congressional
I'm going to leave the handicapping to others. That's what you do. You usually write those newsletters and things. But what we're doing is working with Congress on any questions they have about the agency, about the needs of the agency, about the staffing levels, about the timing of this. And I look forward to working with Congress in any way that Congress would like in terms of securing the resources.
And are you leading that effort in terms of working with Congress, or is it O&D, or has that been engaged at all yet? Where does it stand?
You're talking about our funding, or?
Yeah, right, this piece of the funding.
Oh, that piece of the funding, the President and OMB just recommended, what, about 10 days ago. And mostly what we've been, and I think in the document, if you read it closely, it says that OMB would come back sometime later with some specific legislative proposals or something. So I think that was addressed in the document.
Let me offer one thought, and thank you again, and we'll wind down. The comment before, sort of about trying to explain the super technical stuff you do in ways that can resonate with people. I think, we understand everybody who's sort of from the advocacy community understands your position, your reluctance to answer, take the bait, as you say. On the other hand, the more, and we have a job to do in terms of presenting in clear ways with language that you can't use or won't use about why it's so important for you to have funding, adequate funding. At the same time, it's much more authoritative when it comes from you. So you can't say the same things we can say, but to the extent you're able to connect either backwards looking to the financial crisis, which is not very controversial, you're making the same points, and sort of able to detail how more authority would enable you to prevent things, or future looking harder for you, for example, in the oil price run-up. If it comes from you, then we can amplify it in ways that are way better than if we just sort of assert it on our own. So I think, we understand the position you're in. The efficiency argument is pretty clear. We're talking about tiny amounts of money in the overall federal budget, but that's not, when we go sort of to our base and try to mobilize people, that you're an efficiently operating agency that's underfunded. It's not exactly the most sort of exciting mobilizing line.
Yeah, very good points. I mean, my mom's 84, and sometimes she asks me, what do you do down here in Washington? And I think I've gotten to the point where she did ask me over many months, what's the difference between a future and a swap? And I think I'm sort of there. Look, I think that markets work best when they're transparent, they're open, they're competitive, but yes, when there's a cop on the beat. And that's what the CFTC is. I don't know what city has a police force that's over 680 people, but I should probably learn that the next time I get these questions. It's, when you sort of relate it to the size of the market, which is across this entire great nation, there literally, most companies use these products to hedge a risk. So it could be walking into your local department store and buying something that was manufactured in Europe or manufactured in Asia, and that retailer had to protect themselves against the risk of currency going up or down. Those are the types of things, and the oil that you put in, that we all put in our tanks, and pay more today for than we did a few months ago. It's oversight to those markets that is absolutely critical, and that those markets reflect the forces of supply and demand, that there's enough sunshine on those markets that people can actually see them, and not just the regulators, public sunshine, so that whether it's somebody who wants to write a newsletter or somebody who wants to hedge a risk that's similar, they can see what the last party is that hedged a risk there. But I appreciate what you're saying, and I'll work on my talking points for my mom and you.
Well, we thank you very much for all you did in the Dodd-Frank debate. And it was a position where it was hard for the regulators and others to stand up for a really public interest point of view, and I think a lot of us feel very pleased with what you did.
I think that transparent markets are on the side of the public, but I also think that market participants benefit. And once we work through the clearing issues and the margin issues, I think to the earlier question about those two companies, I think that end users really benefit the same way that my mom benefits, that competitive and transparent markets benefit my mom, who's not in the markets, and those companies as well.
Good. Thank you again very much.
Thanks. Do I take this